To calculate the cost of equity, three critical inputs are being used. One is the risk-free rate, then the beta, and then the equity risk premium. The risk-free rate is simply the yield being commanded upon a fixed income government security, which generally tend to take a 10-year maturity fixed income security, which tends to represent the longer-term growth trajectory of the country. There is no point taking a short-term maturity bond. So for example, and again this needs to be adjusted with the country's default spread. The default spread is simply the difference between a corporate bond, the yield being commanded upon a corporate bond, minus the yield upon the risk-free security. Again, this number can simply be taken from Mr. 𝗏𝗏𝗏, the valuation guru, on website, free of cost, who tends to publish the equity risk premiums, the country risk premiums, as well as the default spreads for all the countries in the world. So for example, the current yield on a 10-year bond is 7% as of now. It needs to be adjusted with the country's default spread, which is closer to like 1.5% to 2% odd. So the actual adjusted risk-free rate, which needs to be used in the calculation of the CAPA model to calculate the cost of equity, is 5% to 5.5%. 7% minus 2% gives you 5%. Beta. Beta is a proxy for systematic risk or the market risk. It is the undiversifiable risk which cannot be diversified even by creating a portfolio. We can talk about this later. ERP is the equity risk premium, the extra premium that you are paying to invest into the broad-based Nifty 50 index fund and not investing into the government bond to get the risk-free rate. Higher the risk, higher is the expected return as the principle of corporate finance. But simply ERP cannot be calculated as simple as that by just simply taking the difference per se. We need to take into account the market risk premium, the mature market equity risk premium of US, and add a country risk premium of India to it. The mature market equity risk premium of US adjusted with the default spread is somewhere closer to like 4.2% odd. And how to calculate the country risk premium is the default spread of my country India into the standard deviation or the volatility of the equity market index divided by the standard deviation or the volatility of the emerging bond market index. Emerging equity bond index divided by the standard deviation of the emerging bond market index. Usually the MSCI is taken right in both these scenarios, and when I calculate the CRP, I can simply add the CRP to my mature market risk premium. So my final adjusted formula for the cost of equity becomes the risk-free rate plus beta into the mature risk premium of the US markets, which is already adjusted with the default spread. Again, this number can simply be taken online via the 𝗏𝗏𝗏 sheets plus the country risk premium of India. Again, you need not calculate this number. It's the formula which I told you just for your understanding. But again, this number is already calculated in that Excel sheet. I can share that link. Thank you so much.